Alright, what's up guys? I want to do another video of Wisewell today. And I want to be going over the discounted cash flow evaluation method, which is one of, if not the most commonly used evaluation methods in accounting. So what what DCF is you are you're estimating the value of an investment by calculating the expected future cash flows. I'll put CF for cash flow. And then you can determine the value of the investment. You can determine the value of an investment based on projections of how much cash that investment will generate in the future. Now, how does the DCF work? So essentially, in the DCF, you're finding the present value of expected future cash flow. And you do this by using a discount rate. You can use the present value of money to determine a future cash flow. So here, let me write this out. It's probably easier. Present. So you can use the present value of money to determine if the future cash flow is greater than the value of the initial investment. And the way you interpret this is the money likely to generate, or is the money the investment is likely to generate in the future greater than what it will be invested right now? So money generated by greater than in what, like the amount that's going to be invested now. And that's essentially the whole idea of this. Now, what it's used for is it's used to estimate the money and the money the investor will receive from the investments. Sorry, from investments. And going back to one of the first videos, this is adjusted for the time value of money. Put TVM, time value of money. And what's the time value of money again? It's the whole idea that money today is worth more than money tomorrow. That's essentially what it is. So I can give you guys an example of this. So say you invested $10 today. Um, so you invested $10 today at a 5% APY or annual percentage yield. So in 1 year, you'll have $10.50 versus if you didn't invest that $10, since it's not invested and it's not making anything, the value of the money will decrease over the next year. So this is essentially the whole idea of the time value of money. And what a DCF is, you take the cash flow and you discount it to adjust for the time value of money. Now, how do you do a DCF? Like how do you actually conduct a DCF? So here's how you do this. The first thing, you have to determine an appropriate discount rate for the DCF model. And the discount rate could vary. The discount rate could vary depending on the asset or project you're you know the asset or project under consideration. Now, it's important to know here that if you estimate too highly, the result could be an overvaluation of the investment, or sorry, an overvaluation of the investment, and the eventual payoff is going to be overvalued. And on the other side, an estimate too low, an estimate too low means that it may make the investment too costly for the eventual profit, which could result in missed opportunities. And now, how do you actually find what the discounted cash flow is? Well, here we go. It's the main part of the whole thing right here. The formula for a DCF is right here. I'll explain what these means after I draw the equation. Sorry, not 1 plus n. It's 1 plus the rate, the discount rate. And then the exponent will be n. Okay. So what does this mean? CF1 equals cash flow for year 1. CF2 cash flow year 2. CFN equals cash flow for n years. So say you do cash flow for 10 years, the n will be 10, and then the r is the discount rate. And how do you find the discount rate? Well, there's multiple ways to find the discount rate. One of the ways is you could use this formula: discount rate equals future value divided by present value to 1 divided by n minus 1. And I'll write these out too. and n equals number of years until future value. And I'll give you guys an example of this. So say the future value is going to be $10,000. Present value is $5,000. And our n is 5 years. So what you got to do is you got to just plug it into this formula. The discount rate is going to equal 10K divided by 5K to 1 over 5 minus 1. Now you have 2, 1 over 5 minus 1. And that obviously put this into a calculator. That's roughly going to be 1.1487 minus 1, which is equal to, and then the discount right here will be 14.87%. On a real world example, probably won't be this big, but I just want to give you guys an example. And another way to find the discount rate, which is usually the most common way, is you could use the weighted average cost of capital which is probably the most common discount rate that's used. And the formula for this is, I'll write out and then tell you guys the values. Okay. And the companies that have preferred stock, it's going to be a little bit different, not much though. I mean, essentially, you have the same thing. So it should be 1 minus 3. And then you have to add cost of preferred stock times percent preferred stock. And that's essentially going to be that. And what these values means is, what these values all mean, here we go. E is the market value of the firm's equity or market cap. D is the market value of firm's debt. V is the total value of capital, which is equity plus debt, or whatever you want to call it, debt plus equity. And then what these means is the percent of capital that's equity. And then percent capital that is debt. And then RE is the cost of equity, or required rate of return. R for rate of return. And then RD is the cost of debt. And the T is just the tax rate. And then the higher the discount rate, the lower the present value of future cash flows will be. So I'll just write greater. Actually, I'll do it this way. So greater discount rate, the present value of future cash flows is going to be lower. So now let's actually do a DCF. Let's run a DCF model. It's actually run one. So the first thing, our weighted average cost of capital is going to be 5%. Our initial investment is going to be, let's say, $10 million. And the cash flow projected for future years for, let's say, 5 years. I'll do that in a chart below. So we have the year, we have cash flow, year 1, 2, 3, 4, 5, and the cash flow is going to be 1 million, 1 million, 4 mil, 4 mil, and 6 mil. So now we go back to the equation, discounted cash flow equation, that is, right here. And now we just plug in the numbers. So all right, let's plug in the numbers. It's going to take a while, but so we have 1 million divided by 1 plus 0.05, because this is the discount rate. 0.05 is the same thing as 5%. Sorry. Let me draw another. Let me draw an easier way to see. We have 1 million. Keep in mind these are millions. And this is the first year. Then we have to do another 1 plus 0.05. The second plus, what do we have? 4. And that's the third year. And we got to do the same thing again. Fourth year. And fifth year. And this should come out to, first year, we have 952. Actually, here, I'll draw the chart again. So we got the year, cash flow, and then discounted cash flow. And these are millions, keep in mind. So I'm just gonna round this up to the nearest dollar. So for the first year, the discounted cash flow is going to be 952,381, and you could just use the calculators to do this. I mean, obviously, I'm not doing this in my head, but second year, it's going to be 907,209. Wait, no, 907,029. Third year, we have like 3.455350. Fourth year, and then the fifth year. And now you add all these up. So on discounted cash flow, and you get $13,306,727. And then the initial investment we said was 10 million. So what you do is you do this amount minus the initial investment, and you're left with 3,306,727. And this right here is equal to your net present value, or NPV. And what NPV is just the difference between it's the difference between the present value of cash flow in the present value of cash inflows and the present value of cash outflows over a certain period of time. Now, since the NPV is positive here, the investment or asset or project could generate a higher return than the initial cost. Which equals a profit. Now, obviously, it's not guaranteed, but it gives you a higher chance. Maybe worth investing in. Now, if the NPV was negative, it would indicate that the investment would cost more than the projected return. So probably should not invest. Now, this is not using the intrinsic value, but you can get the intrinsic value by using a cash flow model, which is what now we're going to do now. All right. So here's how you get the intrinsic value. You need to do the discounted cash flow plus the terminal value. And I'll draw out the steps. So the first thing you got to do is project future cash flows. After that, you got to determine the terminal value. Or, in other words, the value of an asset beyond the forecasted period when the cash flows can be estimated. Now, what's the formula for terminal value? It's very easy. You could use the Gordon growth model. Which is this terminal value equals free cash flow times 1 plus the growth rate divided by discount rate minus the growth rate. And I'll draw these out for you. the offered discount rate. And usually it's the weighted average cost of capital. And now our third step, and find the intrinsic value with a DCF. So choose your discount rate. Fourth step, you discount the future cash flows and the terminal value. And then you calculate total present value. And then you divide by the number of outstanding shares. So here's the formula. So essentially this is just your discounted cash flows. And then this is just discounted terminal value. So I'll do DTV for that. And then you have to divide it by the outstanding shares. You have to divide by the outstanding shares to see if the shares are less than the intrinsic value. And obviously you don't have to do this all by hand. You could just use like an online calculator or Excel. But yeah, essentially that's how you find the intrinsic value. So you could either use the basic way, and if the NPV, net present value, is positive, could be a good investment. If it's negative, you probably shouldn't invest. Or you can actually get the intrinsic value. But they're both pretty similar, and I'll write out some of the pros and cons now. So the pros, you could evaluate investments. You can also apply this to lots of companies and projects. And in most scenarios, you could adjust it to like most scenarios are adjustable. What are some cons? Obviously, this whole entire thing is based off of estimates, so nothing's actually like set in stone. Economic changes, and you shouldn't just use this in isolation. I can't spell, bro. Yeah, you shouldn't just use this in isolation. So what's our overall? The DCF model is one of the most popular, and it's a very good way to calculate a company's intrinsic value per share, or to give you an estimate if the investment is worthwhile or not. You just use you could either use the formula that gives you a net present value, or the formula that gives you the intrinsic value to determine whether you should invest or not. But yeah, that's essentially what a discounted cash flow is. I'm gonna make another another video on the second valuation method, comparable company analysis. That should be coming in the near future. But I hope you guys learned something from this discounted cash flow video.